Do you believe them, Michael, this morning? Is Citigroup telling their clients that U.S. equities are maybe not the place to be? And by the way, they think China outperforms the U.S. in this kind of environment.
Great to be here. Nice to see you. Well, our members do. About 73% of them think recession is likely. Our members tend to be conservative because they're people who have built great businesses and sold them. And so they're now in a wealth preservation mode. But they're well diversified and ready for whatever's going to come.
All right. So if that's the base, that you're drawing this information from, and they are conservative, what exactly are they doing? I mean, this is an inflationary environment. These are people who understand that cash being held on the sidelines is continuously losing buying power. What exactly do you do in an environment where bonds are uncertain, equities are uncertain, and everything else in cryptocurrencies is uncertain as well?
Sure. So our members tend to be long-term investors, and they have some themes. The crypto obviously is very concerning, but for the portion of our members that are invested in crypto, they see this as a buying opportunity because they have a fundamental belief. It's a little like a Tesla owner when Tesla was 1/10 the price it is now. It's come down off its highs, but they've still made fortunes. Our main distribution is public equity and real estate are the two top areas. Real estate has always been king. Oddly enough, in the first quarter, public equities before the market fell became our largest asset. My guess is by next quarter, it'll fall below real estate again. And then private equity, which is a much longer term investment. But those three, private equity, public equity, and real estate, add up to over 70%. That's a pretty long-term risk-on confidence in our economy. So it's true that they think there's recession in the near to midterm, but still long-term confidence. And what you do is you have low fixed income, historically low. We've never had 6%. It used to be around 12. That's a concern about inflation and interest rates, and high cash. Our members run 11, 12% cash so that they're not forced to liquidate precisely at the wrong time, and they have enough dry powder to make a bet when something really looks attractive.
Yeah, especially if you're talking about some of these more illiquid investments like real estate or like private equity and hedge fund investments as well. Could I drift towards the real estate side of things? You mentioned it's always kind of like the top of the heap there. We know that the real estate market is red hot. We know maybe your members are not dealing with the same kind of houses that maybe I'm dealing with right now in my neighborhood because they're ultra wealthy. But is there a feeling there that this is the top of the real estate cycle?
You know, for real estate is not a monolith. The difference between industrial, residential, retail, office, those are all different. Workforce housing in the right communities, people are very interested in continuing to do that, but prices are high. Retail obviously is going through now a second problem. You just mentioned a whole bunch of retailers that are having a tough time. Obviously, with the pandemic, it was even worse. And office is really the most amazing because there the question is, has something fundamentally changed for a generation? Is the relationship between the worker and their office different? Well, it's not in a factory, but if you can work from home 2 or 3 days a week, people are really reconceiving the entire office. So it's very much which is going to win and which is going to lose. There will be winners and losers, but over time, real estate has been our best performing asset. And since our members have made a lot of money in real estate, they have deep expertise, and there's huge opportunities. You know, when you have downturns like this, if you didn't have cash, you're going to be forced to liquidate. But if you do have cash, think of all the opportunities in the technology stocks that have been decimated. That's in the public side, even in the healthcare side, and in the private markets. You know, there's a deal of a lifetime that passes your desk every week if you're able to look for it and seize the opportunity.
I mean, we know that the devil is in the details, Michael, for a lot of these things. But as you kind of put your finger on the pulse of all of these members that are of ultra high net worth, is there a part of that equities market that is more attractive? Is it those mega cap technology stocks, the ones that have been the consensus buy? arguably since the depths of the great financial crisis back in 2009? Is it maybe some of the energy stocks that are kind of running away with things right now? Where exactly is the interest from a stock perspective in some of these more beaten down sectors, perhaps? Maybe not energy.
Sure. Well, technology has always been our number one sector that we're interested in. So people who have expertise in technology, particularly in the B2B technologies, because the consumers have been beaten down a bit, where you have fundamental technologies that underlie large corporations, there's some terrific opportunities there. But our members are also looking for long-term themes. And climate, you mentioned energy. Energy is an all-time high. But climate is a theme. There's going to be $5 trillion a year spent over the next decade. And so things like renewable energy and rebuilding the grid, even the copper that's going to be required to rebuild the grid, these are long-term plays with tailwinds that are almost recession-proof. That doesn't mean they won't go up and down in a recession. It means over the long term, there's just extraordinary value. And there's a lot of those areas. And you mentioned some of them, but technology, healthcare, these are places that really have, if you cure cancer in a good time or bad, you're going to make money.
All right. And Michael, before we let you go, one of the conversations I've had multiple times with folks who are older, wiser, and wealthier than I am is whether they should be continuing to invest in cryptocurrencies. You alluded to it earlier on. But a lot of folks are underwater right now, including some of the wealthier investors that you talk to. Is there a sense right now that they want to continue investing in it because it's like the dollar cost averaging approach, or is this a time to cut your losses and say, hey, you know what, crypto's not for me, I'm going to move on?
First of all, our members are now all around the world, but in a place like San Francisco that thinks there's a recession because of the technology, that's also where some of our biggest crypto buyers are, and those really have a long-term commitment. So for people who really have an understanding and a belief, and I'd say that's 5 or 10% of our members at most, they're going to be really focusing on crypto opportunities. But they're still going to have a prudent allocation. It's like gold has historically been a 1 to 3% allocation of total portfolios, and my guess is crypto is the same. So there's some certain sentiments across our membership, but different sentiments in different locations. Our groups in Calgary thought we were in a recession because of energy a year or two ago, and they're doing very well right now because of energy prices, where it's just the opposite in San Francisco, where the recession is really hitting the technology companies. But you have some real diehard crypto fans all across North America, and most of them would say this is a buying opportunity.